to another Smaulgld live stream. It is February 18th, 2020, and tonight's topic is the national security issue of U.S. stocks, U.S. dollar, and U.S. oil. Recent report, White House considering incentives to spur stock buying. Now, isn't the stock market high enough as it is? Why would the White House want to consider tax incentives for more Americans to buy stocks when the stock market seems to be doing just fine as it is? Now, this is beyond I'm sure it has something to do with electioneering for 2020, but it is part of an overall strategy, historic strategy, that the United States has been engaged in since it attained world reserve currency status in 1944. We're going to go through the most recent proposal, but I want to give you a quick history of the U.S. dollar as the world's reserve currency and how that fits into all this dollar collapse nonsense, which only gets half the story right and basically ignores the other half, which means half right is half wrong. And if you're claiming an absolute of dollar collapse and it doesn't happen, well, then you are 100% wrong. And this is a topic I want to revisit because I've been talking about this for 6 or 7 years, saying that the dollar's not going to collapse despite the U.S.'s unsustainable debt and so on. And the part of that reason is how the Fed and the U.S. Treasury manage the U.S. dollar. And it's not just about managing the dollar and all this nonsense about end of the Petrodollar, end of dollar hegemony, gold back yuan, game changer, and so on, is really half-baked analysis. And I believe it's either half-baked analysis based on genuine ignorance, meaning they just don't know any better because they just repeat what they hear, they don't look at the full analysis, or it's a narrative, and a narrative is designed to sell newsletters and gold, and once they get married to the narrative, they're not leaving it because that's what made them their money or continues to make them their money. And one thing is true, it is a very popular narrative. You put out gold, a dollar collapse, or end of the petrodollar, any of that type of information, you're guaranteed to get an audience because there's a large following of people who believe in that stuff and they need reinforcement so they can binge watch that type of video. Of course, this is not going to be one of those. So let's start, before we get to the current day, back to 1944. World War has ended. The United States emerges as the only superpower in the world. And so the central banks meet at Bretton Woods in 1944 and they debate for a while whether they should have some type of international currency like the Bancor, which is what Keynes wanted. The parties did not want to go with that. Obviously, the United States was going to be in charge of the issuance of whatever the currency was going to be. And they ditched the gold standard idea, but they still wanted to have gold in the system. So they said, well, the United States has got all the gold. The United States is the world's largest exporter. Every other country is in ruins. The dollar is the gold standard. The dollar will be backed by gold by any central bank that wishes to take its dollars back to the U.S. Treasury. They can redeem those dollars for gold at $35 an ounce. And that was the deal. Now, remember, the price of gold at $35 an ounce was the same price that it had been set in 1934. At $35 an ounce by an act of Congress, the Gold Act of 1934. With that price, there really wasn't an issue in 1944, 1945, 1946, because in the balance of trade, no country was really accumulating dollars. They were having to import U.S. goods, so they were having to spend their U.S. dollars. So there wasn't really a big demand for convertibility of overseas dollars into gold at the U.S. Treasury. So the United States held on to most of its gold. But as we'll see as the years went on, after the 50s, during the 1950s, Europe, which was really the only substantial competitor to the United States in terms of global economic output, they started to develop their own economies very well. They started to become export engines. Italy developed an automobile industry with Fiat. Germany did the same. So did France. Germany also, and so did Italy, started making refrigerators, white good products like that. And a lot of them started to find their way to the United States. And some of these countries started to build up trade surpluses with the U.S., which meant they had some dollars that they could redeem. And as the 60s went along, the United States not only lost some ground in its economic prowess and balance of payments, but it engaged in a massive government spending or massive government spending programs in the way of Johnson's Great Society in 1965. You had the welfare warfare state now in full effect in the 60s because you had the Vietnam War raging. Johnson also sent 500,000 troops to Southeast Asia. And the United States was also engaged in a space race and an arms race with the Soviet Union. So lots of money coming out of the United States coffers, inflation starting to rise in the 1960s. European governments led by Charles de Gaulle, president of France in the 60s, Switzerland and Germany in particular, started to ask for redemption of an increasing amount of their U.S. dollars. Now this, of course, was a, quote, threat to dollar hegemony. And the reason is the United States had a limited amount of gold. And if they were going to convert every dollar, which under the Bretton Woods Agreement, they were obligated to do so, eventually, in a couple of years, they would run out of gold. Now, I covered this topic a couple of years back when there were some newly unearthed CIA documents. Now, this again was a matter of national security. What was the CIA interested in gold in the late 60s and early 70s? Well, they were concerned about the production of gold, how much gold was being produced, because in a sense, production of gold was money printing. And at the time, South Africa had significant geopolitical significance because it was the world's leading gold producer. The second world's leading gold producer at the time was Russia, but Russia was part of the Soviet Union. So the, quote, free world gold and the free gold world price was $35 an ounce, irrespective of what might be happening in China or Russia or the Soviet Union at the time. And the free gold world supply was largely in South Africa. So the CIA kept a very tight watch on what was happening in South Africa and also what was happening in the Swiss gold market, because the United States was adamant about maintaining the $35 gold peg. Now, they could have avoided this because the problem with the gold standard, the U.S. dollar standard backed by gold, was as international trade grew, not only did the European countries start to hoard more dollars and then have more dollars to convert into gold, but the economies of the world grew, but the global gold supply did not grow with it, which meant that the price of gold was severely undervalued if it was meant to represent a backing to the U.S. dollar. Now, that problem could have been solved by the United States just revaluing the price of gold higher. They could have taken the price higher to $70, $80, $100, whatever the amount might have been required in order to make the gold supply roughly equal to the increase in demand since 1934 in demand for currency to fit the size of the global economy. The United States didn't want to do that, but it did in 1969 allow the IMF to come up with the SDR scheme, which was designed to say, look, there's not enough liquidity in the system in terms of dollars. We can add these SDRs. We can give them out to people, not to people, but to central banks, and they can use them. The idea really never caught on. The SDRs are still held by pretty much all central banks that were issued them over time, but they have not really become a major reserve asset or a major asset that countries trade. We stuck to the dollar. So the United States in 1970 sold or lost 700 tons of gold. Now, that is a staggering amount of gold lost, and that was lost to Switzerland, Germany, and France, who were requesting gold for their dollars. The following year, in 1971, the CIA noted that the United States sold a staggering amount, even more than 700 tons, nearly 800 tons or 768 tons of gold. And this was pretty much straining the United States, and it looked like they were going to run out of gold. The United States sold a staggering 24,685,714 ounces of gold in 1971. France bought 420 of those tons of gold from the U.S. in 1971. Switzerland picked up 155 tons, Belgium 98 tons. This was a massive drain. Now, when you put these numbers together, 700 tons of gold each year, more than 700 tons of gold, 1970, 1971, leaving the United States. That's probably the largest transfer of gold in any two given years, because Think about the big stories about Russia. Russia's buying gold hand over fist. Well, first of all, Russia buys the majority, if not all of its gold from its domestic mines. Well, in the big year in 2018, Russia acquired a, quote, staggering 224 tons. Well, the staggering amount of 767 tons in 1971, which came on the heels of 700 plus tons in 1970, dwarfs that staggering amount. This is also at a time, remember this is the early 1970s, where the gold mining was less than half of what it is today. So this really was a large percentage of the world's gold reserves heading out the door. Russia's 224 tons, while it's a large amount, is about 8 or 9% of the world's today's global mining production. It's a big amount, but it's nothing near this big deal of 700 tons leaving in the 70s. So in 1971, Nixon, under the guise of claiming that there were speculators out to ruin the U.S. dollar, decided the gold window will temporarily be closed to those countries who are entitled under the Bretton Woods Agreement to get gold. They just weren't going to get it anymore. And that was the end of that. And that ushers in the period of what they call the petrodollar. And again, a lot of people miss these points. They just insist that the world is just like before. And the end of the petrodollar means the end of dollar hegemony. Now, a lot of people said, and rightfully so, or predicted, that when the United States went off the gold standard in 1971, or took the world off the dollar gold standard, it was really a dollar standard backed by gold, so that would be the end of the dollar. Now, there was some real basis for that, because if European countries were the major economic powers other than the United States, and they had started to catch up to a certain extent to the United States, they were no longer in war-torn ruins, although the UK still was in the early 50s, but France, Germany, Italy, and to a lesser extent, Belgium and Spain and Portugal were coming out of their economic doldrums and really starting to increase their economies. And if they weren't going to get gold for their dollars, the question became, this is before the euro, why should we use the dollar? And that is when the world's reserve currency came into question. Now, at the time, remember, the United States is used to having this status, and it's basing its economic and geopolitical strategies on the fact that the world needs dollars and will continue to need dollars, and the United States wants to continue to fight wars, continue to provide welfare. They just increased Medicaid, or created Medicaid, in 1965 on Johnson's Great Society. They landed on the moon already, but the space race still wasn't over. The arms race with the Soviet Union wasn't over. So the United States, as a matter of national security, needed to maintain that, quote, dollar hegemony. So Nixon and Kissinger quickly put together what's known as the petrodollar agreements. And that was simply that the United States would protect and defend Saudi Arabia and supply military hardware to Saudi Arabia and some of the Gulf states if they would only just price their oil in dollars and sell it only in dollars, thus creating an artificial need for dollars. Well, that made the European countries realize they had to start to keep some dollars aside in reserve, and it created a demand for the dollar. Yes, that created a demand for the dollar, and it did help the United States get through the very rough period of the 70s, but that didn't stop the inflation. And it wasn't really until the late 1970s, early 1980s, that the United States got out of its funk and raised interest rates, broke the back of inflation with Paul Volcker as the head of the Federal Reserve under Jimmy Carter and then under Ronald Reagan, so that finally inflation was quelled, and then we had the boom period of the 1980s. And yes, during that time period, during the 70s, the petrodollar agreements did indeed keep the U.S. dollar front and center, because without gold, many thought that the dollar would go under. Some also thought that gold would also be relegated to the status of trinkets, that it would be good for rings and statues, but without the monetary component of gold, the price of gold would actually drop and there's really nothing to worry about. That turned out to be 100% false, because the European central banks, for years after the ripping up of the Bretton Woods Agreement, were hopeful and lobbied for, but never really got it, obviously, that the United States would go back to and take Nixon's temporary closing of the gold window and go back to offering the dollar, even if it was at a higher price, gold in exchange for the dollar. But that never happened. But what also didn't happen was European central banks did not throw aside the gold that they had accumulated. They either kept it at the U.S. Fed, or they had gone to the United States, picked it up and brought it home in warships and kept it in the Banque of France or wherever else they were keeping it. Germany was keeping some in England and at Deutsche Bank and so on. So the Europeans decided that gold was still part of the monetary system. Bank of International Settlements, the IMF, still required gold as an entree point for any countries looking to join. So gold never left the monetary system, even though the United States wanted to break the peg entirely and say, look, the dollar is the dollar because it's the dollar, and the dollar, as Nixon said, draws its strength, as does any currency. He just became an armchair economist on the basis of the strength of its economy, and the United States is the strongest economy, therefore the dollar should be the strongest currency. To a certain extent, that was true, but it was true because the United States was unable, it still needed gold. But the trick that they pulled off was, now we don't need gold anymore. The dollar is just a dollar. Europe wasn't really buying it, and so the United States came up with the petrodollar. Just as the gold standard, when the United States went off the gold standard, the dollar again was threatened. But the petrodollar saved it. Many people started then to predict the end of the petrodollar. And with the end of the petrodollar, there'd be end of dollar hegemony, and that would be game over and game changer, and nothing would work anymore because the dollar was going to get crushed because we no longer had the petrodollar. But in the 80s, things changed. Countries started to hold dollars, not just because they had to buy oil, but because as their international trade grew, the dollar remained the currency that countries chose to hold, not just to buy oil, but just chose to hold as a reserve currency. Deutschmarks, Swiss francs, central banks held those as well. Remember, at the time, there was no viable Chinese yuan. You still had the Soviet Union. Countries weren't going to hold Belgian francs, Italian lira, English pound. They weren't going to hold a whole basket of currency. There was no euro, so the dollar developed its own basis of reserve status outside of the petrodollar. Then, now we're getting into stocks. And this is another point that people miss, is that somehow it's all about the dollar or it's all about the stock market. It's not. It's all about both. The stock market is about having a worldwide liquid market of dollar-denominated assets. And if you have dollar-denominated assets, what happens? People need dollars to buy dollar-denominated assets. Now, back in 2016, I think Peter Schiff still says to this day, I believe, the Fed is going to sacrifice the dollar to save the markets. Why would they do that? Well, it's almost because a lot of people have to look at things in a binary fashion. Dollar or stock market? What do we choose? Well, the Fed seems to be off their rockers. They're profligate. They're going to crush the dollar themselves, or China will crush the dollar. But we got to preserve the stock market at all costs. Actually, the United States has two twin goals, in my opinion. They are well aware that the stock market is a national strategic asset as well as the dollar. In fact, if they had to choose, which I don't think they do, and it's obvious recently that they haven't had to choose, they would choose the dollar over the stock market, because without the dollar, they don't have anything. They can't play their games. They can't do QE. They need to have that demand for dollar strong. And when you have the demand for the dollar strong, you can boost the stock market. You can boost assets. You can do whatever you want. And if you can boost both, they're actually synergistic. If the stock market's going up and it's attracting capital, well, that's attracting dollars, and you need dollars to buy stocks, and there's another need for dollars, other than in addition to all the need for dollars that countries have to borrow in dollars because it's the currency that everyone wants. So now they have to pay back those dollars in dollars, and that means they got to get dollars. So there's a demand for dollars, and of course there's the countries holding on to reserves. They're going to hold on to them in dollars. In most cases, 65-70% of the global central bank reserves are in dollars, and there's a demand there as well. So back in 2016, I asked that question, will the Fed sacrifice the dollar to save the markets? And the spoiler alert was no. And I went through what happened since 1987. Now, in 1987, the stock market crashed. Now, we had a period in the 1970s of, from really the 60s to the 70s, 10 years of maybe even more of no growth in the stock market going down 20, 30%. And since 1987, most of you, your lifespan is within that period, you don't really remember a period of prolonged stock bear market. You have these little dips and drops, but they don't last. And there's a reason for that. The United States realizes that the stock market, the U.S. stock market, is a strategic asset of national security. Just as the CIA was looking at the gold market because it had an impact on the U.S. dollar, they look at the stock market as well. In fact, there was I think there's a book called The Firm. It's a fictional account of the CIA, and they talk about how Russia always wanted to crush the U.S. stock market, not necessarily the dollar, because it viewed that was a way of crushing the United States. So it is a strategic asset, and that became very clear in 1987. The stock market crashed in 1987, and what was the response? Well, this entered in the modern times. Ronald Reagan had appointed Alan Greenspan in early 1987, I believe. And when the stock market crashed, newly appointed Federal Reserve Chairman Alan Greenspan calmed the markets, noting the Fed stands ready to serve as a source of liquidity to support the economic and financial system. So the stock market went down like 520 points that day in October. That was good for about a 20% drop, I believe. The next day it went up. It was like the biggest gain in history. Went up like 220 points. And that 1987 stock market crash did not turn into the type of stock market crash that we had in 1929, we would kind of set off the Great Depression. That was just a blip in the 80s stock market boom that pretty much lasted and was still going on through the internet bubble, through the tech bubble in the 1990s, the internet bubble in the early 2000s. And then you did have the financial crisis of 2009. Now, 2009 comes along after years of stock market gains. And people are thinking, well, this has been the end of the stock market. And now what's going to happen? What's going to happen now is the United States got to do something dramatic. And dramatic they did. $4.5 trillion in stimulus in the form of QE, $800 billion bailout from the U.S. Congress, and the taking of interest rates down to zero. Now, you would think that would be enough to crush the dollar. But as I pointed out in that 2016 post, and as I pointed out in 2014 and 15, that the U.S. would raise interest rates, that they would not allow rates to go below zero, and that they would raise rates, and everyone was saying, no, they're going to go below, they're not going to raise interest rates, they're not going to normalize rates, they can't do that, because they were worried the impact it would have on the stock market. And my argument all along was they would do it to protect the dollar. They can worry about the stock market later, and as we've seen, they managed to pull it off. They did both, i.e. achieve a rising dollar and a rising stock market, and to boot, a rising gold price. And remember, my theory on the gold price rising never relied on China to crush the dollar or dollar collapse or end the dollar hegemony, but more on the fact that the dollar and the gold would rise together, and also that gold would be considered, along with the dollar, a safe haven. Now, a lot of people are, again, they get binary. It's gold or the dollar or gold. Gold is the anti-dollar. No, gold is the anti-fiat currency. But the dollar is the anti-non-dollar fiat currencies, and it is by far the strongest. So here is Chai Girl, who is in. Now, the thing about her is she is an oil analyst. So she's not infected with the gold mentality. She also said in 2018, 2 years after I was talking about 3 or 4 years, it's not that this is my only original idea. Other people have it too. But here she is in 2018, and she was saying, back when the price of gold was $12.42 and the dollar was 97, and dollar index, was that they could rise together. I totally agree with that, and I said yes, the gold will rise when the dollar collapses. Narrative due to unsustainable U.S. debt and China's secret plan to crush the dollar and issue gold-backed yuan. that was always rubbish. And it turns out, she's pointing out today, if you look at your prices, she's looking at them today, that gold was $1,605 at $1,600 now, and a dollar index is 99.43, and I'm looking at a dollar index of 99.43. So there you have it. She was correct, I was correct. And again, she's coming at it from, she doesn't have any preconceived, binge-watched a bunch of gold pumper videos. She's just looking at things as an analyst would do. And she just happens to be a gold analyst and a oil analyst and an oil trader. Now, it was much harder for me to come to that conclusion because I was well steeped in the whole China to crush the dollar, unsustainable dollar collapse, end of dollar hegemony, multipolar world, and all that other nonsense. All right, so now you're up to 2009, and it looked like, let's take a look at that chart. And this is where you can see how the Fed and working with the U.S. Treasury managed through its, I would say, the toughest period for the dollar, the toughest periods for the dollar hegemony being threatened, where when Nixon took the U.S. off the gold standard, they really had to scramble to get those petrodollar agreements in place. We're going to talk about that in a second. And then the second time was when they did the first QE. The problem with the first QE was China had just, over the last 5 years, prior years, purchased $1 trillion worth of U.S. Treasuries. Japan had $1 trillion worth of U.S. Treasuries. And the United States just decided we're going to buy $2.5 trillion worth of U.S. Treasuries. That basically cheapened their entire investment. And that got a lot, that stirred up a hornet's nest. That was the whole, the BRICS have had it. They're going to crush the dollar. They're looking for alternatives. Yeah, well, they wanted to have alternatives, but they really didn't have alternatives. But the dollar index did fall. So let's take a look here. From 2006 to 2008, the dollar was falling. QE actually strengthened it the first time, but the longer QE1 went on, the dollar index fell. Well, that's when they stopped doing QE, and then the dollar index rises. And then when as the QE continued, QE2, the dollar index fell, so they stop it. Then the dollar index rises, and then they do QE again. Now, the curious thing about QE3 I thought, which was the biggest QE to date, was going to be the one that there would be no looking back from. That was the biggest QE of all, and the dollar index had not yet recovered to the levels that had recovered after QE1 and QE2, and here they were starting QE3, and I actually thought game over at that point, that they were going to burst the bubble right here by doing QE3. Well, the funny thing happened with QE3, not only was it the biggest one, it did not have that negative impact on the dollar. And the reason was, the entire time they did QE3, all they did was talk about ending it, tapering it, and then raising interest rates afterward. That was enough. Those are what I called Fed yak attacks to keep the dollar on an even keel. And you can realize behind the scenes, they were working on making sure that Japan, as soon as the United States stopped QE, started theirs. Stanley Fischer, the vice chair of the U.S. Federal Reserve, who was a mentor to Mario Draghi of the ECB, he went to Draghi during that time period and said, hey, Mr. Draghi, you know, this QE stuff works. The ECB should consider it. And Draghi said to him, you mean we just printed the money? And Stanley Fischer says, yeah, that's what you're doing. He says, okay, we printed the money, we see what happens. And that's exactly what happened. So at the end of QE3, Japan started theirs, and a few months later, the ECB started theirs. During this whole time, while China was complaining that the U.S. was doing QE, they were doing their own form of stimulus and borrowing in dollars, which they're continuing to do this day. And the rest of the world went mad on zero interest rates and negative interest rates and QE, when the U.S. stopped doing QE in 2014. And then the Fed actually did go through a period from 2015 to 2018 of raising rates. Then they started lowering rates again in 2019. And now they're back to doing not QE, repo QE, but so is China. Japan is buying 60% of the ETFs in that country. Swiss National Bank is buying stocks. So all the central banks, European Central Bank is negative rates, Bank of England, zero interest rates. All of the central banks are engaged in a massive profligacy. And the United States Federal Reserve, while it is too, has demand for the dollar for the reasons we discussed, which are there's demand for the dollar because the dollar is still the reserve currency and countries still hold dollars and borrow in dollars and therefore need dollars. Now, the other issue that people miss, and they keep talking about the petrodollar, end of the petrodollar. China is going to demand that Saudi Arabia pay for oil in yuan, and then, but we know that Saudi Arabia is not stupid and they don't want the yuan because it's not a very good currency. And then this whole nonsense story came about that China was going to allow Saudi Arabia, whoever else would buy the yuan, to be convertible into gold on the Shanghai Gold Exchange. Now, this story was dead on arrival for anyone who had half a brain, because we know China does not allow gold to leave the country. There'd be no purpose in doing that. That's not internationalizing the yuan. Any country that would back its currency with gold and so you can have gold instead, well, of course, people would use that currency. It'd be as good as gold. But China was never willing to give up its gold. Never made sense to do that. There would be no victory in doing that because it would be an admission that the yuan is toilet paper unless it was convertible into gold. And besides, there's nothing stopping Saudi Arabia or anyone who is accumulating dollars and doesn't want them. They don't need to borrow in yuan. They don't need to use the yuan, accept yuan, and then convert that into gold. They can just convert their, quote, worthless dollars into gold anytime they want. So this whole story never made any sense. Game changer, China to crush the dollar, petro yuan. This was a story back in 2017. There's like 6 gold pumpers mentioned in it. And of course, they never, you can't prove it's not going to happen. Well, it hasn't happened. It's not going to happen. And that was another story. Now, the other problem with the petrodollar, the end of the petrodollar, end of dollar hegemony is it presupposes that the world is 1973. That the world has no reason to hold on to dollars other than to buy oil from Saudi Arabia. Now, back in 2015, I was saying that, well, first of all, that's ridiculous because the dollar has a demand for its own, on its own, much greater than just the need to buy oil. But let's step back. The petrodollar agreements are still in place. Saudi Arabia has not backed away from those. Anyone saying that they backed away, that was just speculation. And in the last 3 years, the petrodollar, or at least the Saudi Arabian portion of the petrodollar, has been strengthened because the United States, or Trump, has undone the Iran deal, which means, remember, Saudi Arabia and Iran are mortal enemies. They practice 2 different types of Islam. And the United States shunning Iran and getting closer to Saudi Arabia means that Saudi Arabia is not looking to ditch the dollar and to accept the yuan of any form. The other thing that's happened with Saudi Arabia is no longer the world's largest oil producer. I had predicted back in 2015 if the United States became the world's largest oil producer and largest oil exporter, then they wouldn't necessarily need the petrodollar backed by Saudi oil. They can have the petrodollar backed by U.S. oil. Well, guess what? They have both. And also, the ties between the United States and Saudi Arabia have increased due to the breaking of the Iran deal and also to the United States looking the other day on the Khashoggi murder. But also because what has Saudi Arabia done with all those dollars they've accumulated? Did they go out and buy gold? Nope. They're heavily invested in U.S. stocks in Silicon Valley. So that tie is there. So what do they do with their dollars? They reinvest them in the United States stock market. See how this is all working? U.S. dollar, stock market, oil. U.S. stock market, dollar, oil. All working together synergistically. And now it's U.S. oil. So it's U.S. stock market, U.S. dollar, U.S. oil, Saudi oil, all going back into dollars, dollar-denominated assets in the stock market. And that is why the dollar is still strong. Now, it's not lost on people who like gold, but not because of these ridiculous China to crush the dollar, that there still is a level of manipulation and artificiality in it. All this is basically an arrangement, an agreement. The stock market wasn't up 35% in 2019 because earnings rose 35%. It was up because it was boosted. So that takes us to today, where we are. What's going on? Well, first of all, let's look at the dollar index. That other chart I showed you showed how the U.S. got through to 2016. But look, since 2016, look what the dollar index is. It's not being crushed. It's at 99, as Chai Gold pointed out. That takes us up to today. Where are we today? Well, now we're talking about buy stocks, get a tax break. A couple of months ago, they were also saying, and I actually like this idea, and it's the Democrats think it's tax avoidance, but I don't think it is. It was to provide for a inflation adjustment credit to your stock or capital market gains or capital gains. And the reason for that is, if you bought a house in 1968 for $35,000 and you sell it today for $350,000, you didn't really make $200,000, $300,000. What did I say? 35,000 and 335,000. Yeah, you didn't make $300,000. You made something a lot less than that in real terms. So why should you have to pay tax now on $300,000? That's one idea they're talking about. And that one actually isn't really underpinning the stock market, although it would give a boost. I mean, it works the same for stocks. If you held Apple stock since 1999, you have a big gain. You've lost some of it to inflation, so they would adjust that. But the real kicker now that they're talking about is giving countries the ability to not countries, people. My phone is ringing. Giving people a tax break for buying stocks. Now that would put more money into stocks, and they can do the same thing with bonds. The problem with bonds are they're not very attractive. I mean, the U.S. Treasury is yielding about 2% right now, so they can force people to buy bonds. But always better to give incentives if you want the market to react. Both if you want the dollar to react, if people think that U.S. citizens are being forced to buy bonds, that's not as strong as there's this natural demand for bonds, even though it's not natural, it's geopolitically induced. But getting people to invest in stocks would just mean, well, if the United States citizens have an incentive to invest in stocks, that means stocks are going to go up. And what's that going to do? It's going to attract more dollars from overseas into the stock market, and that's going to push stocks higher. All right, let's see what you guys think of all this. But remember, the way I look at it is, the U.S. views the stock market, its oil production, and its dollar as strategic assets. It's not going to sacrifice any one of them. Not if it doesn't have to, and it certainly doesn't have to play one off of the other. Let's see what you guys are saying here. All right. What do we got here in the comments? Pablo and Fiona. Hello, guys. Good thing about silver is money, says Pablo. No need to quarantine, unlike the yuan this day. Yeah, unlike the yuan these days. Yeah, I had that. I was going to cover that today. Let me show you. Where is it? Cash and coronavirus. Yes. There you go. Another reason to ban cash. China quarantines cash to sanitize old banknotes from virus. So yes, indeed, that is... and that's been known for a long time. That's not a reason to ban cash, but it's a reason to be wary of banknotes and to wash your hands after you handle cash, because I think in the 80s they said like every $100 bill virtually had like cocaine residue on it, or any used $100 bill or even $20 bills. All right, where's Barry is here, Scott Wardell is here. Not a binary guy, as Lewis is not. How long the dollar goes is any fool's guess. Yeah, you see, when you run the table, you can make things that should be binary work and not be binary. In other words, if the United States runs the whole show, has the economic might, has the military might, and has the ability to make it so, well, then it can make so things that would normally be in Congress. But that's how it works. All right. All right, everyone. Well, it looks like that's it for tonight. I look forward to talking to you again, probably tomorrow. So thank you very much for joining me tonight. If you enjoyed this podcast, please consider supporting Smaulgld at the ways you can see up there on the screen. You can send items of value, check, cash, and so on to Smaulgld LLC or silver or gold, P.O. Box 714, Dover, New Hampshire, 03820. You can donate via Bitcoin or Litecoin. And I also do appreciate those who have done so. And also, you could become a Smaulgld patron. You can be a subscribe star member, or you can donate via PayPal, one time or recurring. Do appreciate all of the letters and donations that I do receive, so thank you very much, and we will see you soon.